Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. In the world of finance, there are famous stories of individuals who made fortunes by capitalizing on stock market crashes. These tales, which have been depicted in movies like The Big Short, often involve savvy investors who implemented specific strategies to profit while others suffered losses. One notable figure is Michael Burry, who gained recognition for successfully shorting the stock market in 2008. His story was immortalized in the film mentioned earlier. Another renowned investor, George Soros, made headlines by shorting the British pound and earning a staggering $1 billion in a single day. Additionally, Andy Krieger made millions by taking advantage of the New Zealand dollar's sharp decline, known as the Kiwi crash. These individuals possessed unique tactics that allowed them to thrive during market downturns, unlike most investors who experience significant losses by withdrawing from the market. While it's impossible to guarantee that you'll achieve millions of dollars, I will outline strategies that can help you make good profits during a stock market crash. Let's consider some infamous examples of stocks that turn into horror stories. Take GoPro, for instance. At one point, many believed this company would be valued at tens or even hundreds of billions of dollars. However, fast forward to today, and the demand for GoPro cameras has dwindled significantly. As a result, the stock price has plummeted by over 90%. Another more recent case is Aurora Cannabis. When Canada legalized the use of marijuana, there was substantial optimism surrounding Aurora, and people anticipated its tremendous growth. However, once the initial hype subsided, the stock suffered a significant decline, falling from 150 Canadian dollars to under $10. Remember, investing in the stock market always carries risks. While these strategies have proven successful for some investors, there's no guarantee of achieving extraordinary profits. It's crucial to assess your risk tolerance, seek professional advice, and make informed decisions based on your financial goals and circumstances. Choosing the right investments. Investing small amounts of money now and giving it time can potentially turn into millions in the future. To achieve this, you need two key ingredients: a high return on investment and time in the market. The recipe for success involves investing after a market crash when returns are likely to be higher and allowing your investments to compound and grow over time. Choosing the right investments at the right time is crucial for making money from a stock market crash. Let's consider a graph by Fidelity that illustrates which sectors perform well in different parts of the market cycle. At the top of the cycle, it's wise to adopt a defensive strategy. Investing in precious metals like gold, consumer stocks that are not cyclical in nature, and healthcare stocks, which remain essential regardless of market conditions, can be beneficial. However, when the market starts crashing, you need to adjust your strategy. At the bottom of the market, consider investing in consumer cyclicals and financial stocks because they tend to be exceptionally cheap, and few investors want to own them during a downturn. As the market begins to recover, it's time to shift focus towards sectors like transportation and especially technology. After a crash, technology stocks are often undervalued but possess significant growth potential. For example, since 2009, Apple stock has surged over 6,500%, Amazon over 4,500%, and Netflix over 4,000%. After a market crash, it's crucial to select the right type of stocks that have the potential to be disruptive over the next decade or so. Identifying these stocks early on and reinvesting your profits can lead to substantial gains. While most people fear market crashes, having the right mindset and employing the current tactics can turn a crash into a tremendous opportunity. Remember, investing always carries risks, and past performance does not guarantee future results. It's important to conduct thorough research, diversify your investments, and seek professional advice to make informed decisions aligned with your financial goals and risk tolerance. By applying the strategies mentioned in this video, a market crash can become a chance to create wealth and seize great opportunities. Best time to buy. Since March 2009, the stock market has experienced a remarkable growth of over 400%. This means that if you want to make money in the next market crash, it's crucial to remember that the best time to buy is during a crash when everyone else is in a state of panic. You might be thinking, well, a 400% increase is not necessarily going to make me a millionaire. And that's absolutely true. However, there's one thing you might be forgetting: the incredible power of compound interest. Let me illustrate this power with a story. There was once a man who approached a wealthy queen and asked for one thing before he died. The queen agreed, curious about the man's request. The man pointed to the chessboard the queen was playing on and said, Grant my family 1 grain of rice for the first square, 2 for the second, 4 for the third, and so on for all 64 squares. The queen, thinking it was a small gesture for a dying man, agreed to the request. However, the queen soon realized the astonishing implications of compound interest. When she calculated what 2 raised to the power of 64 amounted to, she discovered that even her entire kingdom could not produce that much rice. The man's request turned out to be far more significant than anyone could have imagined, and the queen had to give her entire kingdom away to fulfill it. This simple tale demonstrates the immense power of compound interest. When you invest your money and earn returns, those returns can be reinvested, leading to exponential growth over time. Even if the stock market doesn't make you an instant millionaire, the compounding effect can significantly increase your wealth in the long run. So in the next market crash, while others are panicking, remember the potential of compound interest. By investing wisely and allowing your returns to compound, you can harness this power to steadily build your wealth over time. It's important to remain patient, stay focused on your long-term financial goals, and let the power of compound interest work in your favor. It's advisable to conduct thorough research, diversify your investments, and seek professional advice to make informed decisions that align with your financial objectives and risk tolerance. Emotional investing. During the market crash, the average American stock investor lost more than half of their wealth in a little over a year. Some unfortunate investors even lost over half of their entire life savings within a year. This often happens due to emotional investing, as Warren Buffett refers to it. When the market hits rock bottom, people tend to withdraw their money and seek safer assets like cash in the bank. They believe that stocks are no longer a good option and they have suffered enough losses. This emotional response creates a significant opportunity for investors who can keep their emotions in check and make rational decisions based on facts. The truth is that around the bottom of the crash, usually when prices are falling and stocks are considered cheap, many people sell their shares out of fear. This behavior is driven by emotions rather than a logical assessment of the situation. However, this panic selling creates an enormous opportunity for investors who can remain calm and analyze the facts. In early 2009, for instance, it was the best time to invest. Stocks had crashed and everyone was in a state of panic, selling their shares. It was as if there was blood in the market streets, as the saying goes. But that's precisely the time when one should consider buying. It's like taking advantage of a sale on stocks. Warren Buffett, for example, was cautious in 2007 and mainly invested in bonds. However, in 2009, after the crash, Buffett went on a buying spree. He utilized the cash he had saved up for a long time and invested heavily. This bold move paid off significantly. Those who had the courage to buy during the panic and recession made the highest returns. It's important to know that investing based on emotions can lead to poor decisions and missed opportunities. While market crashes are distressing, it's crucial to remain rational, assess the facts, and consider investing when prices are low. Warren Buffett's strategy of buying when others are selling has proven successful time and time again. Shorting. Money making in a market crash can be challenging because it's difficult to predict when it will happen. It could occur 5 years from now, which is why I'm cautious about shorting the entire stock market. Timing such bets is tricky because despite short-term dips, the market generally grows over time. Therefore, I don't consider it a good idea to bet against the entire market, as it consistently makes money and expands, with occasional downward blips that are unpredictable. Instead, the preferred method for profiting during a crash is to identify overhyped and overvalued stocks or currencies. These are assets that are easily recognizable as being inflated in value. Shorting these specific assets can yield good returns. However, I don't recommend shorting the entire stock market as a whole. The decision ultimately lies with you. Another approach to making money in the market crash is what Warren Buffett refers to as his method. This is the method I personally use as well. Let's look at a recent example from history. The years 2007 and 2008 were challenging for most investors due to the housing bubble crash. House prices plummeted and the market crashed as well. From November 2007 to March 2009, the market experienced a decline of over 50%. To follow the Warren Buffett method, one should focus on the long-term perspective. During a market crash, stock prices often drop significantly, presenting buying opportunities. By investing in fundamentally strong companies with promising future prospects, one can take advantage of the market's recovery and make substantial profits over time. It's important to remember that market crashes are unpredictable, and investing always carries risks. While shorting overvalued assets or following the Warren Buffett method can be strategies for making money during a crash, success is not guaranteed. It's crucial to conduct thorough research, seek professional advice if necessary, and make informed decisions aligned with your financial goals and risk tolerance. Identify trends. One recent example of a stock that generated a lot of hype but ultimately crashed is Nikola, a company associated with electric vehicles or EVs. However, not all investors lost money on such stocks. There were astute individuals who recognized the excessive hype and chose to short these stocks when the bubble burst. By shorting a stock, you profit when its price goes down, but you lose money if it goes up. If you can identify when stocks are overhyped and overpriced, you can make money by shorting them. Sometimes it's evident that stocks are overhyped. You may encounter people like your neighbor John, who knows little about investing but talks about buying a particular stock. The stock might be all over YouTube, the news, and social media. These are often signs that the stock is overpriced. For example, during the peak of the Bitcoin frenzy, everyone was talking about it. Even your friends who had no idea what investing meant were buying it. Eventually, the Bitcoin bubble burst. One way to profit during a market crash is by shorting specific individual stocks. This was a tactic used by Michael Burry, who made money by shorting subprime mortgage bonds, and George Soros, who earned $1 billion by shorting the British pound. Another daring approach is to short the entire stock market. Currently, the market is at or near all-time highs, and many believe it's overvalued. Even Michael Burry himself thinks that the market is overinflated, suggesting that index fund inflows are distorting stock and bond prices, similar to how CDO purchases distorted subprime mortgage prices over a decade ago. He predicts that when these flows reverse, it will result in a severe crash. It's important to note that investing in stocks always carries risks. While shorting stocks can be profitable, there's no guarantee of success. It requires careful analysis and understanding of market trends. It's crucial to evaluate your risk tolerance, seek professional advice if needed, and make informed decisions aligned with your financial goals and circumstances. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.